Okay, let's talk Wingstop. We're breaking down their Q4 2025 earnings report and, more importantly, the really powerful and honestly kind of puzzling way the market reacted. Let's get right into it. So, right off the bat, the market sent a message, and it was a loud one. The stock just exploded higher, jumping over 16% to land around $293 a share. I mean, that is a massive vote of confidence from Wall Street.
But here's the head scratcher, the thing that has everyone talking. Wingstop actually missed on its top-line revenue expectations. So, what exactly did investors see that made them hit the buy button so aggressively? That is the central mystery we're solving today.
To really understand that big rally, we have to start with the numbers themselves. And what you find is, well, it's a classic mixed report card. You've got some real weakness in there, but also some pretty surprising strength.
This slide really lays out that split perfectly. You can see the revenue miss plain as day, 175.7 million versus the 177.6 million consensus. But look, the real story here is on the bottom line. Adjusted earnings per share came in at $1, completely crushing the 83-cent estimate. Profitability was just way stronger than anyone thought it would be.
And this gets right to the core tension in the entire report. On one side, you have this impressive 8.6% year-over-year revenue growth, which is really being driven by all the new stores they're opening. But on the other side, you've got a pretty significant 5.8% drop in domestic same-store sales. And what that means is that their existing restaurants are actually selling less than they were a year ago.
So you're probably asking, how did these completely mixed signals lead to a massive stock rally? Well, this is where we get into the psychology of the market, and it's a great example of why a negative number can sometimes be a really positive thing.
This quote just nails it. It captures the whole vibe. See, heading into this report, the fear, the real panic, was that the consumer was about to fall off a cliff, and same-store sales will be an absolute disaster. The fact that the decline was only 5.8%, well, that was a huge sigh of relief for investors.
So here's the crucial takeaway. The market made a choice. It chose to focus on the parts of the Wingstop story that are durable, the parts that are built to last. That profitability beat was huge. It showed just how resilient the business model is. The comp decline, while not great, wasn't the catastrophe people were braced for. And most importantly, investors looked right past the short-term consumer weakness, which, let's be honest, everyone saw coming, and they focused on the long-term story, opening more and more stores.
Okay, so if that long-term story is what really matters, what is management actually doing to drive it? Well, they laid out a really clear two-part strategy. It's all designed to speed up growth and push their average restaurant sales up toward that big $3 million goal. And here they are, the two big pillars of the plan. First, the Wingstop Smart Kitchen, and second, the launch of their new loyalty program, Club Wingstop. These are the key bets they're making to tighten up operations and get customers coming back more often.
Now, the Smart Kitchen thing, this isn't just some small tech upgrade. No, this is a fundamental change to how they do business, and it's been rolled out to nearly 2,600 restaurants. The goal is simple, but it's incredibly powerful. Get every single order out the door in 10 minutes. That means better speed, better consistency, and ultimately a much better experience for you, the customer.
This chart really helps visualize all the different growth levers they're pulling. You've got the Smart Kitchen, which is all about getting more efficient. Then there's Club Wingstop, and the early tests are already showing a really promising 7% jump in how often members visit. But look at that last bar. The biggest driver by far is still just raw unit expansion, a whopping 493 net new stores last year.
And all of that growth brings the grand total to 3,056 restaurants system-wide by the end of the year. You have to understand, this number right here, this is the absolute core of the bull thesis. As long as Wingstop can keep opening profitable new locations at this kind of pace, the market is more than willing to look past a few short-term bumps in the road.
So with all that said, what's the outlook from here? Let's break down management's official guidance for 2026 and then see how Wall Street is thinking about the stock now that the dust has settled.
You can see management is being pretty cautious on the consumer. They're forecasting domestic same-store sales to be anywhere from flat to maybe up a few percent. But, and this is a big but, they remain extremely aggressive on expansion, guiding for another 15 to 16% growth in global units. It's the same playbook, manage the short term, but keep that growth engine firing on all cylinders.
And after the report, Wall Street is clearly split. You've got the bulls, like BTG, who are sticking with their buy rating and a massive $400 price target. And then you have the more cautious camp, like TD Cowen, holding the line at $285. This really shows you the debate that's raging right now between that incredible long-term growth story and the stock's current very high valuation.
So our take here at Talk Tickers is a market perform rating.
Look, we absolutely believe the powerful franchise-driven unit growth story is real and it's durable. But all that optimism has to be balanced against the very clear short-term pressures on the consumer and a valuation that, frankly, already has a lot of that future growth baked in.
All right, for our final segment, let's have a little fun and pitch a trade idea. Think of this as the kind of outrageous but plausible idea you might hear tossed around in a hedge fund meeting, one designed to isolate a very specific thesis.
Here's the play. It's a pair trade. You go long on Wingstop stock, but at the same time, you short the XRT, which is a big, broad retail ETF. Here's the logic. The thesis is that Wingstop's specific growth story, driven by its great economics and that smart kitchen rollout, can outperform even if the consumer gets weak. So by shorting the XRT, you're hedging out that broad market risk. You're betting against the very consumer weakness that management is worried about, which lets you isolate your bet on Wingstop's ability to just execute their plan.
And of course, as always, please remember that this is for informational purposes only. This is not financial advice.